for the last 18 years as a top-ranked investment bank analyst and also portfolio manager. You are currently in charge of the European equity research for Bloomberg's team based in London. Mike will share with us a quick summary of the global auto demand and will also give us an overview of the financial perspective of the industry. Please welcome Mr. Mike Dean.
So much.
Hi, Mike. Thank you.
Bonjour and good afternoon, and welcome to my presentation. Hopefully I can give you the financial view of the European automotive companies and how they're perceived by the stock market, and compare this to Tesla, which is very highly valued and treated as a tech company. I covered the sector for 18 years, and unlike some of my younger peers, I've actually seen some business cycles. Global automotive demand doesn't just keep going upwards. And I remember when I first started at Merrill Lynch, the previous Peugeot CEO, Jean-Martin Foltz, said that the automotive industry was no longer cyclical. Luckily, I didn't take that view into the financial crisis, and I believe we are pretty close now to the top of the automotive cycle. Just a brief word on what is Bloomberg Intelligence. Bloomberg Intelligence is the in-house research function for Bloomberg, the financial media company. And it's accessed by 400,000 terminal subscribers, which are mainly investment professionals, fund managers, traders, but also increasingly corporates because of the insight that we have into industries, but also companies. We cover every global industry and cover over 2,000 companies globally. And together with Bloomberg New Energy Finance, we're one of the biggest research houses and definitely on par with some of the sell-side US investment banks. So this is just a brief summary of the European automotive companies, and you can see that they're in pretty good health. We've got revenues of over €500 billion and profitability expected this year of up to 50 billion, which would have been higher, but we've had recent profit warnings from the likes of Daimler and BMW. This is a massive transformation from 10 years ago when many of the auto companies were facing bankruptcy. Indeed, GM went into Chapter 11. Peugeot, Renault and Fiat had to have government bailouts. And the reason for this transformation is not just good management, and we'll hear from some of those managers later, but also we had a massive upturn in global automotive demand. Firstly, it came from China from 2010, then we had a recovery in the US, and then we've had a massive upswing in demand in Europe since 2013. The US market has peaked, it's come off since 2016, and I think we're pretty close to a peak in terms of European automotive demand, but China will continue to grow. So despite these strong profits and strong demand, the European auto sector is very much unloved by stock markets. And the graph here shows PE ratios, which is the, how many times an investor will pay for the forward earnings of a company. And you can see the white line is the European auto sector. It's currently at just under 7 times. And the orange line is the European stock market, which is under 14 times. Historically, autos have traded on a 30% discount to the sector because it's a cyclical industry and because it's had poor returns on capital. That discount has increased to a whopping 50%, and this is on the back of uncertainty created by unknown future revenue streams caused by tech disruption from new technologies. So what do investors like? Well, they like autonomous driving, and they like electric vehicles, and they like e-mobility. And what this chart here tells you on a quarterly basis of the investment put into autonomous driving and e-mobility over the past few years. This investment topped $28 billion last year and is set to be even higher this year. Of course, the traditional auto companies are investing their R&D also into these areas, and this is shown in the next chart. as we can see, and this is R&D over time for the European car companies. For many of the car companies, this R&D expense has doubled, with the exception of Peugeot. And I see this R&D peaking in 2019, 2020, as we have the accelerated rollout of electric vehicles. The next chart plots revenues versus profitability for the European car companies, and the size of the bubble is the market capitalization for these companies. As you would expect, Volkswagen, with 250 billion euros of revenues and almost 20 billion of profits, is in the top right-hand corner. But what does stand out is Tesla in the bottom left-hand corner. And not just because I put it in red, but it has a similar market capitalization to the likes of BMW, and it's on par with the combined value of Renault and Peugeot. And this is because we have these inflated expectations for the company going forward. In fact, expectations are probably as high as the Tesla Roadster that's currently floating around in space. This is despite recent launches by the likes of Audi, Mercedes, and Jaguar, which has effectively ended Tesla's monopoly on premium electric vehicles. Renault is the battery electric market leader within Europe, so the European car companies do have these tech credentials. It's just down to these companies to better structure their businesses and actually get more favorable valuations from investors. What I'm showing in terms of the yellow bubbles is the potential if Volkswagen were to be a bit bolder in its restructuring and highlight its tech businesses a bit more brightly. In terms of some of the parts, Volkswagen's Porsche business, if it's put on par with Ferrari, because they have similar EBITDA margins, is worth over 100 billion euros. It's about to spin off a trucks business, and these combined restructuring would give it a market valuation 3 times its current value. It's a similar story for Renault. If you take and combine its Nissan, its Daimler, and its cash positions, they amount to 19 billion euros, and that compares to a current market value of 22 billion euros. So this is valuing the core Renault business at just 3 billion euros, which is too low. So everybody wants to be Tesla, but the problem is the transition to electric will be slow, it will be costly, and it will pressure current margins. What you can see from the chart on the left is the average discount for a plug-in electric vehicle in Germany. It's 20% of the list price. At best, electric vehicles currently, even when sold at full list price, are making little or no margin. So when you're having to discount these cars by up to a fifth, you can see why the Europeans have been so slow in pushing their electric rollout. But this will be accelerated over the next couple of years, and certainly from 2020, the sector needs electric vehicles to meet new emission targets. Another reason for the low profitability, on the right-hand side, you can see battery prices per kilowatt hour. This has come down significantly over the past few years and is around $200 per kilowatt hour at the moment. We think this will come down to about $100 by 2025, and at that point, electric vehicles will then be competitive with their combustion engine counterparts. Just to give you an extreme view of what can happen in the future, just a few points from Bob Lutz, who was previously head of development at GM and is very well respected. He sees a point in the future when 20 to 30% of cars on the road are autonomous vehicles. And this will coincide with a massive drop in accidents and deaths on the road. However, at this point, governments will just ban human drivers altogether. These autonomous vehicles will be similar in styling, have blunt ends on both sides, and they will form train-like formations on motorways. They won't be branded by traditional auto brands, but rather by the mobility provider, such as Uber or Lyft. Because there'll be no overtaking for these cars, performance will no longer be a differentiating factor, and therefore this will be the death knell for some of the performance and premium brands. The key question here is, can the current traditional automakers be the mobility providers of the future? And given what the stock market thinks of these companies at the moment, that is certainly unclear. Final slide just shows you what we think EV penetration will be in the key markets over the next 7 or 8 years. We will see that China will take the lead, given new energy vehicle rules that come into introduction from 2019. We think Europe will be as high as 15% by 2025, But given that we're not quite sure where EV demand will be in 12 months, it's very difficult to have a real gauge on where demand will be in 6 or 7 years. The take-up of autonomous vehicles will also be slow. And this is before autonomous vehicles can operate safely within towns and cities and also become more affordable, which is probably not such a bad thing given the previous slide. So in conclusion, I believe there's a bright future for European automotives. There will be some casualties on the way, but certainly the car companies currently have the right credentials, the right tech credentials. They just need to structure their businesses in a way that investors can see this and attract the correct value in terms of the overall value of a company. I think CEOs could certainly take a leaf out of the late CEO Sergio Marchionne of Fiat's book in terms of extracting shareholder value and how he has done that at Fiat over the last 10 years. So merci beaucoup. That's the end of my presentation. Thank you for listening.
Well, thank you very much, Mike, for this very valuable information that we will certainly use on our next panel. So it's